Today we are looking at 3 stocks that you should be watching to maybe buy during the next downturn. I bet that at least one of the picks will be a surprise for you. We got 2 tech stocks with impeccable financials and 1 ETF that's a little bit controversial. What is up everyone, it's Alex here. Today we are looking at 3 stocks that you should be watching to maybe buy during this fall. Let's start with stock numero uno, Alphabet, the parent company of Google, YouTube, and a dozen more. Here's a brief overview of Alphabet. Alphabet is a collection of businesses, the largest of them all being Google. All other businesses are considered by Alphabet as other bets. When Alphabet refers to Google, their largest business, they talk about Android, Chrome, Gmail, Google Drive, Google Maps, Google Play, Google Search, and my favorite, YouTube. Because you can smash the like button for the YouTube algorithm. 83% of Alphabet's revenue comes from advertising, and while this is one of their strengths, considering the fact that this allows them to have a gross margin of 55% plus and a 20% plus operating margin, this is also one of their weaknesses because the advertisers can decide to stop advertising on Alphabet altogether, and they can also choose to terminate their agreements with Alphabet at any time. So I'm giving you this as a perspective so you can better have an idea about the business. What is fascinating though is that YouTube revenue is up 35% since 2007, which is one thing to keep in mind. Let's take a look at Alphabet's financials, and for the purpose of this video I'm going to focus on their growth rates for revenue, EPS, equity, and also return on invested capital to look how management is doing. The revenue growth for the past 10 years for Alphabet sits at 21%, the 5-year growth rate sits at 19.5%, and the 3-year growth rate at almost 15%. The 10-year earnings per share growth rate is at 70%, the 5-year one is at 18%, and the 3-year one is at 20%. As for equity, the 10-year equity growth rate is at 17.7%, the 5-year is at 13.6%, and the 3-year is at 13%. So as we can see from the revenue, the cash, the EPS, and the equity, Alphabet grew at a rate of over 10% year over year for the past 10 years, which shows that their moat continues to be strong even nowadays. So when I'm looking at those numbers, I'm looking at how the business is holding up, how well are they growing, and what's the potential for this business to grow in the future. Now, while past performance does not guarantee future performance, it's still a great thing to look at because it might give us an idea about how well the business was doing and how well it might be doing in the future. If we look at how effective the management was, the numbers speak for themselves. Alphabet's 10-year return on investment capital is at 14.5%, the 5-year one is at 13.7%, and the 3-year one is at 13.9%. The total cash position of Alphabet, meaning cash and cash equivalents, for Q2 2020 sits at around $121 billion. Their long-term debt as of Q2 2020 was sitting at $4 billion. Compared to their revenue and their cash position, the long-term debt of Alphabet is nothing to worry about. Alphabet's current ratio, meaning the current assets divided by their current liabilities, is 3.42, which is stellar. Anything above 1.5 is great. 3.42 is stellar. Pricing wise though, Alphabet sits at fair value, so if you are willing to pay fair value for the business, then by all means go for it. But if you want a margin of safety, it might be better to wait for the stock to drop a little bit before starting to buy in. That's why I said in the beginning that it's worth keeping on the watch list, but maybe buy during this fall if there's going to be some sort of market correction. A second business that we're going to talk about is probably obvious for me, but it's Facebook. And before you click out of this video, please hear me out. I already made a video in detail about Facebook, which you can check. I think it's going to be right here. But for the purpose of this video, we are going to focus on the growth rates that Facebook had, which I did not cover in that video, to have an idea about their juicy financials and what a compounding machine Facebook actually is. After you see the growth rates for Facebook, this might change your perspective a little bit about the business. As a brief overview, Facebook is one of the biggest players in the social media space, owning Facebook as a platform together with Facebook Messenger, Facebook Shops, Facebook Marketplace and others, and also Instagram and WhatsApp. Facebook is also getting into the gaming space with Facebook Gaming, and they are also getting in the currency space with Libra. Take a brief look at Facebook's balance sheet for Q2 2020. Facebook was sitting at $58 billion in cash with $0 in long-term debt. If you look at Facebook's current ratio for Q2 2020, Facebook had $68 billion in current assets and $11.3 billion in current liabilities, giving them a current ratio of 6.18, which is insane. Now here's the great part. Let's take a look at the growth rates of Facebook for revenue, earnings per share, and equity, and then we'll move on to the return on investment capital. For Facebook, I'm only going to focus for the past 7 years. So here we go. For revenue, the 7-year revenue growth rate sits at 49%. The 5-year revenue growth rate is at 22.9% and the 3-year one is at 19.5%. For EPS, the 7-year growth rate is 130.8%. For 5-year is at 42.4% and for 3 years is at 21.9%. The equity growth rate for 7 years is at 36%. For 5 years is at 23% and for 3 years is at 19.5%. The numbers are excellent. They look even better than the numbers for Google. This shows that Facebook still has a strong moat that's supported by the numbers that they have and the growth rates that they have. The management seems to be very effective considering the average return on investment capital of Facebook, which is 15.6% for 7 years, 18% for 5 years, and 22% for 3 years. Since my last video, the Facebook stock price shot by about 20% from where it was, trading at around $280 at the time of making this video, which is still below the fair value number that I put on Facebook, and it's trading right now at around a 20% discount, which is not bad, but of course we would like a little bit more as a margin of safety. Finally, the controversial ETF that I was talking about, which is the SPDR Gold Trust, ticker symbol GLD. Okay, I am pretty sure that I lost about 70% of you by this moment, so let's move on. Gold is considered a store of value as opposed to fiat currency during economic times where central banks print money like crazy, just like they do nowadays. Like Mr. Powell's printer is on fire. Ray Dalio sees gold as a powerful diversifier that will balance an investor's portfolio, reducing its risk. Nowadays, Ray Dalio sees gold also as a return-enhancing investment. Contrary to many, Dalio is very bullish on gold, but not only does he talk the talk, he also walks the walk. As of today, 20% of Ray Dalio's portfolio is in gold, mainly in gold ETFs, which is 15% higher than his usual position of 5%, which is an increase of about 300% if we look at it that way. 15% of Ray Dalio's position in gold is in the SPDR Gold Trust ETF, ticker symbol GLD. And this is the reason why I chose it, because it's also the world's largest gold ETF. The expense ratio of the GLD ETF is at 0.4%, but you can decide to go for a lower expense ratio if you go with the iShares one that has the ticker symbol IAU, which sits at about 0.25%. If you're investing from Europe like myself, you also have the option to go with the iShares Physical Gold ETF, which has an expense ratio of 0.15%, which is the lowest of them all. So if you like to own gold but do not like the idea of holding physical gold, then this might be a very viable option for you because it will also provide you liquidity. So if you want to get out, you can very easily sell. Considering the vast experience of Ray Dalio, his thorough research on what happened in the past, and also his track record it might pay to take his advice and have a little bit of gold in our portfolio. Now we can see that his position in gold went up huge from 5% to 20%, but it might pay for us to understand why he acted like he acted, why he increased his position this way in gold. And well, while we don't see inflation now, we might very well see inflation in the future, and well, it's kind of an uncertain economic time. And he basically did the research for us and he's showing us what he's doing. So it might be worth paying attention to what one of the greatest investors as of today are doing. Alright everyone, I want to thank you so much for watching this video. I hope you enjoyed it and you found it useful. If you did so, all I ask is to please consider giving it a like because it tremendously helps with the YouTube algorithm. Feel free to subscribe if you want to join the family and if you want to learn more about personal finance and investing and join my way on the path to fire. And until next time, take care, have a wonderful day, and don't forget that you are amazing.